1 billion. That was Anthropic's annual revenue 15 months ago. Today, 20 billion. And they just published a study using their own data showing which jobs AI is already doing. Not in 5 years, now. 75% of programming tasks, 70% of customer service, done. Meanwhile, last week, a crypto exchange got direct access to the Federal Reserve. First time in history. Something big is happening, and most people are watching the wrong part of it. Hey, welcome back. I'm Kirill Talai, investment analyst with over a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today we got 3 stories to cover. First, Iran. I think the acute phase is ending, but the structural damage underneath is not. Second, AI disruption. I'm going to show you the numbers that should change how you think about the job market and the economy. And third, evidence that something new is being built. Real data points from the last 2 weeks. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but always do your own research before making any investment decisions. All right, Iran. We called it. Last episode we said this would be a shorter conflict, and that's exactly how it's playing out. Trump posted a threat to Iran. The US will hit 20 times harder if they touch the Strait of Hormuz. But the framing is what matters here. He called this entire military operation a gift to the world. When someone starts reframing a war as a gift, they're building the exit ramp. The pattern is always the same. China trade wars, Greenland, Liberation Day. Trump escalates hard, then reverses. Iran follows the same trajectory. So could we get a relief rally here? Sure, a lot of hedging unwinds, we get a snapback. But I wouldn't chase it. The system is still digesting something much bigger than Iran. And that's the story I really want to focus on today. Because the damage underneath is real, and it started well before Iran. Gas at the pump, up about 33 cents. One of the biggest weekly moves in over 20 years. It's starting to normalize, but the inflation print coming in April is going to be elevated. That makes the Fed's life harder. And the impact goes beyond oil. Qatar, the world's largest LNG exporter, about 20% of global supply, has had production facilities offline since the strikes. Europe gets roughly 12 to 14% of its LNG from Qatar. That might not sound like a lot, but Europe already cut itself off from Russian gas. Germany, the largest economy in Europe, is especially exposed because its heavy industry runs on natural gas, and it shut down nuclear capacity. European wholesale gas prices jumped 50%. And here's the asymmetry that matters. The macro models that we track show the US economy was actually still recovering before Iran hit. Europe already rolling over, growth declining, inflation spiking, liquidity drying up. The US is insulated as a domestic energy producer. Europe and Asia are absorbing the full force of the shock, and Europe was weaker going in. Now on jobs. The headline unemployment rate is still at a solid level, and I want to be fair about that. But zoom in and the picture gets tricky. The US lost about 92,000 jobs in February, and if you strip out healthcare, the country has not created a single net new job in over a year. The problem with the healthcare jobs is that they are not economy dependent. Hospitals hire nurses whether the economy is growing or shrinking. So when healthcare is the only sector creating jobs, it tells you very little about the actual business cycle. And in February, even healthcare went negative. Now on the private credit story we've been following, it is accelerating. We covered blue oil last time. Since then, Blackstone had 1.7 billion pulled out by investors. And BlackRock disclosed that a $25 million loan to an Amazon aggregator called Infinite Commerce was marked at full value 3 months ago and now for zero. It's the second loan they've written to zero in back-to-back quarters. On top of that, their $26 billion private lending fund had to cut withdrawals. Investors wanted to pull out 9% of the fund, and BlackRock said, no, you can take only 5%. When some of the biggest names in finance are marking loans to zero and limiting withdrawals in the same week, that just shows structural stress. And it was building long before Iran. So, my read. The Iran shock is probably fading. A bounce is probably coming. But the credit stress, the job market weakness, the technology repricing, none of that resolves because a shipping lane reopens. So, stay cautious. This episode is brought to you by Anderson, a global software development company building high-quality custom solutions for finance, healthcare, and beyond. Now, the force causing all this pressure, it is accelerating. Let me show you the numbers. Let me start with the chart. This is Anthropic's revenue, the company behind Claude. December 2024, $1 billion. End of 2025, $9 billion. March 2026, roughly $20 billion. 15 months, 20x. To put that in context, it took Google about 7 years to go from $1 billion to $20 billion in revenue. Facebook took about 5. Anthropic did it in 15 months. And 80% is coming from businesses. 500 enterprise clients. This is corporations replacing entire workflows with AI right now. Now, Anthropic just did something no other AI company has done. Their research team published a study on how AI is actually impacting the labor market. Instead of making predictions, they used a large sample of real-world professional conversations with their AI and mapped what people are actually using it for against every occupation in the US economy. So, what did they find? Computer programmers. 75% of their daily tasks are already being performed by AI. Customer service, 70%. Data entry, 67%. Financial analysts, 57%. They did not find mass unemployment, not yet. Unemployment rates for these workers are still basically flat. But they found something more subtle, and I think more important. Hiring of young workers, those that are aged between 22 and 25 years old, into the most exposed occupations has dropped about 14%. That's directly from the study. They tracked how many young people are starting new jobs in AI-exposed fields versus non-exposed ones. And the gap opened up starting in 2024. So the people currently in these jobs, they're mostly fine. But the next generation is not being hired. And the latest jobs data confirms exactly this pattern. If you are 22, coming out of college with a degree in computer science or marketing or finance, the entry-level jobs that were supposed to be your on-ramp, they're quietly disappearing. Not with a headline, not with a layoff announcement. They're just not being posted. And the share of industries actively adding workers has been shrinking steadily since 2024. Over a year of this trend. And companies are being explicit about it. Oracle, this week, for example, thousands of layoffs to fund their AI build-out. Companies cutting headcount not because the business is failing, but because AI lets them do the same work with fewer people. Now, we've covered the repricing of the technology sector in previous episodes, but what's happened since is that it has spread to places most people didn't expect. Visa, for example, down 9% year-to-date. American Express, down 16%. The S&P 500 is down just about 1%. Every business that makes its money by sitting between two parties and taking a fee, payment networks, IT outsourcing, insurance brokerage, is getting hit. Let me give you a concrete example of what this looks like in practice. A Spanish insurer called Tuio just launched an AI app inside ChatGPT. You talk to it, you describe your apartment, it asks you a few questions, and in 2 minutes you have a real, personalized home insurance quote. No broker, no forms, no phone call, no human involved at any point. On this news, insurance broker stocks dropped 10 to 12% in a single day. That's not a disruption announcement, that's a live product available right now. And every industry that sits between the customer and the service, collecting a fee for the privilege, is looking at the same future. And the trajectory for a lot of these companies is worth thinking about. Ford stock is the same price today as it was in the 1990s. 36 years. Ford didn't go bankrupt. They still make cars, they still have revenue, but the future wasn't theirs. The stock just went nowhere for a generation. I think that's the outcome for a significant part of the fee-extracting economy. Not zero, but not where you want your capital for the next decade. But look, this is not a bearish story, because the economic activity isn't disappearing, it's moving. Transactions are still happening, just on different rails, at different costs, with different infrastructure underneath. And for the first time, we have real evidence of where it's going. So, where is it going? 2 data points from the last 2 weeks, and a conclusion that I think most investors are missing. Last week, we gave you the framework: stablecoins as the currency, blockchains as the rails, Bitcoin as the collateral layer. That was theory. This week, I have the receipts. First, March 4th, Kraken Financial became the first digital asset bank in American history to receive a Federal Reserve master account. Direct access to the US payment system, the same rails that JP Morgan and Goldman Sachs use. A crypto-native company now plugs directly into the most important financial plumbing in the world. And it was barely a headline. Second, there is a protocol built by Coinbase called X42. It launched in May 2025. What it does is let AI agents pay each other directly using digital dollars on blockchain. No human in the loop, no bank account, no credit card. 10 months in, we got over 160 million transactions, about 43 million in total volume. Still small. Proof of concept, not proof of scale. But the plumbing works. AI agents are settling transactions on-chain, autonomously, right now. Now, we talked last time about stablecoin volumes, 12 trillion in adjusted transfers in 2025, approaching Visa and MasterCard combined. Goldman Sachs projected that AI agents will account for more than 60% of the application layer's economics by the end of this decade. Machines transacting with machines. That volume has to settle somewhere. And the networks processing these transactions are already showing real growth. Take Solana. Its fee revenue has been climbing for 6 straight years. The valuation multiple relative to fees is still high, comparable to a high-growth company like Palantir. But the question that matters is whether this fee growth is driven by real economic activity or speculation. If agents become a meaningful share of on-chain volume, these networks start to look less like a speculative bet, but more like infrastructure. Now, I want to be clear. There is a real question about whether this activity settles on open public blockchains or on private corporate networks. Companies like Circle and Stripe are building their own settlement systems. That tension is unresolved, but the direction is clear. The financial system is being rebuilt around programmable money and AI-native settlement. And here's where I want to leave you with something to think about. Everything we've talked about today, the technology repricing, the payment companies getting hit, the job market shifting, the private credit stress, all of it comes down to one thing. AI is making it impossible to predict what any business looks like in 3 years. The certainty that justified these valuations, these lending structures, these business models, it's gone. So where do you put capital in a world where every company with a business model is at risk of disruption? Bitcoin doesn't have a business model. There is no CEO to fire, no revenue stream that AI can compress, no margin to erode. It's not a company. It's not a product. It just sits there, cryptographically secured, decentralized, and completely indifferent to whether AI disrupts insurance or payments or consulting or anything else. And in a world where cyber risk is escalating, where AI itself is now sophisticated enough to find vulnerabilities, write exploits, and attack systems at a speed no human team can match, the cryptographic security of blockchain becomes an asset in itself, not just a feature. We saw it during the Iran crisis. Stocks fell, bonds fell, gold fell, Bitcoin held. When everything built on the business model is being questioned, the asset with no business model to break starts to look like the safest place in the room. Now, we laid out our structural positioning in the last episode. That framework hasn't changed. What's changed is the evidence is getting stronger every week. Kraken getting a Fed account, AI agents transacting on chain, and an asset that doesn't care what AI disrupts because there is nothing to disrupt. The thesis is moving from theory to data, and I think the market is still early in recognizing it. That's it for today. 3 things. 1. The Iran shock is probably ending, but the cracks underneath aren't going anywhere. Don't chase the bounce blindly. 2. AI is reshaping the labor market and the economy faster than most people realize. The evidence from Anthropic's own research is striking. 3. The new financial system is no longer theoretical. The plumbing is live. The transactions are real. And the asset that benefits from all of this disruption is the one with nothing to disrupt. Tell me what you think in the comments. Like, subscribe, notifications on, and see you next week.